Hello students, welcome to ShirtBack Academy. In our lesson today, we're going to be continuing in Module 1 of our Personal Finance course. In our lesson today, we're going to cover Section 1.5. The topic is net worth. Let's begin. The first component of net worth are assets. Assets are what you own. Assets can be anything that a person or business owns that can be exchanged or sold for money. There are several common asset types that we should be familiar with: individual, organizational, financial, and physical. Individual assets are those used by people for everyday common tasks. These could be driving your car, living in your home, using a watch. Organizational assets are used by businesses for their normal operating activities. These could be their offices, equipment, or factories. Financial assets are the monetary and cash holdings of a person or a business. These can be savings, employee pensions, or investments. Physical assets will be the property that is sold that is received by its cash value. This can be real estate or personal property such as jewelry or even a business. Liabilities are what you owe. Liabilities are any money, goods, or services that are owed to another person or business. Our liabilities are defined by the legal contracts that we sign between all the parties. Personal liabilities are money and services that are owed by an individual to a third-party creditor. Some common personal liabilities include student loans, credit cards, auto loans, and income taxes. Commercial liabilities are the money and services owed by a business to a third-party creditor. Some common commercial liabilities include building rent, goods and supplies, work projects, or FICA taxes. Once we calculate our assets and liabilities, we can determine our net worth. Net worth is the total value of all of our assets minus all of our total liabilities. It is what is owned minus what is owed. Fair market value is commonly abbreviated FMV. Fair market value is the estimated cash we can expect if a physical asset is sold to the public. We use fair market values commonly with homes and cars. Carrying value is the value of a physical asset within a financial document. Carrying value may not reflect the fair market value of the asset. For example, we could have an old appraisal on a home and its value has gone up in several years. Debt is the obligation of a person or business to pay money or perform services to another. The debtor pays the money, the creditor receives the money. Installment loans are debt that uses fixed payments over an agreed upon length of time. Balance sheets are the financial documents we use to provide a summary of a person or business's assets and liabilities. We can use it to determine a net worth. Balance sheets are required in several common situations. We need them to file income tax returns, to apply for bank or student loans, to submit a grant proposal, and when we're seeking investors for our business. Fixed assets are those that we purchase for long-term use. They're not easily convertible into cash. Examples would be land, buildings, or equipment. Current assets are cash or items that can be easily sold. These can be things like our inventory or stocks. Equity is the ownership of an asset that has a debt or loan attached to it. Equity is calculated by subtracting the debt remaining from the asset's cash value. Let's take a look at a couple examples. Our first example, we purchased a home for $120,000. When we purchased the home, we put a $20,000 down payment. The bank gives us a mortgage loan for $100,000 that we will repay over 15 years. When we buy the home, we have $20,000 of equity. It's the property value, 120, minus the bank loan, 100. 5 years go by, we still live in the house. Now we only have $70,000 remaining on our mortgage. But now our house has been appraised at $130,000. The value's gone up. At this point, our equity has now increased to $60,000. It's the property value, $130,000, minus the loan, $70,000. Appreciation is when an asset's value increases over time. In our example above, the house appreciated $10,000 over 5 years. Appreciation can arise if we have scarcity or high demand. Scarcity is when an asset is rare or hard to find. High demand is when we have many buyers for our asset type. Depreciation is the reduction in an asset's value due to the passing of time or wear and tear. There are 4 ways we can calculate depreciation: straight line, unit of production, double declining, and sum of years. Let's take a moment to discuss each one. Straight line depreciation is when we divide the asset's useful life by its original cost. Let's take an example. We buy a tractor for $10,000, and the tractor is expected to run for 10 years. In straight line depreciation, we will have an annual depreciation of $1,000. We take $1,000 for each of the 10 years of the tractor's life. Unit of production is when we divide the total asset output by its total useful life output. Let's take an example of a printer. We buy a new printer for our office and it costs $1,000. The printer has a useful life of 100,000 paper prints. We have already used 50,000 paper print pages. If we used unit of production, our depreciation would be 50%. We have used half of the printer's useful life. On the printer, our depreciation would be half of what it cost. It cost us $1,000 to buy. Our depreciation would be $500. Double declining depreciation is pretty straightforward. All we're doing is taking the straight line depreciation and multiplying it by 2. In our example up top, instead of having 1,000 depreciation over 10 years, we would double that. We would have 2,000 over 5 years. Our final depreciation is sum of years. Sum of years is when we add together all of the digits by counting backwards in an asset's expected life. Let's say we have an asset whose useful life is 5 years. What we do is we start at the number 5 and count backwards, adding as we go. 5 plus 4 plus 3 plus 2 plus 1. When we add all those numbers together, we get 15. Then what we do is we start in year 1 by taking the highest depreciation amount. We take the first year, which will be 5, and divide it by the sum, 15. So in year 1, our depreciation would be 33%. It would be 5 divided by 15. In year 2, our depreciation would be 4 divided by 15, 27%, and so on. Human capital are the skills, knowledge, and experiences that each person contributes to a community or business. They help to produce value through creativity and education. There are 3 common types of human capital: intellectual, social, emotional. Intellectual capital is the total of all the educational skills and knowledge within an organization. Social capital is a shared trust and identity amongst your employees. It helps to foster collaboration and cooperation on projects. Emotional capital are the shared positive feelings among a group's members. It helps them to form relationships with each other. That will conclude this lesson. If you have any questions about the contents of this lesson, please review the course notes for section 1.5. In our next lesson, we will begin Module 2, Spending and Borrowing. Our topic will be section 2.1, Spending Plan. We thank you for following along to the video. We hope you enjoyed the lesson. Enjoy the rest of your day. Take care, everybody.